and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today are Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer, and Graham Buck, writer at CTMfile. Welcome to this episode of the Open Treasury podcast, Paul and Graham.
Thanks, Push. Appreciate you having me back.
Yeah, and nice to join you both.
Absolutely. A very big thank you to you both for taking the time to share your thoughts with us on topics that impact the world of corporate treasury management and beyond. It's time to delve deeper and get your perspective on our topics for today, namely BRICs challenging US dollar and developed world's dominance, China's real estate crisis and rate cut disappointment, Eurozone's modest economic growth while the Dutch economy enters recession, and finally, Citigroup's survey that highlights challenges from accelerated settlements. Our audience can read articles, interviews, and industry roundups by visiting CTMfile.com or by following the links in our show notes. Let's start today's discussion with our first story, which is about the BRICS plan to expand the bloc and boost their currencies against the West. Leaders from world's five leading emerging economies, Brazil, Russia, India, China, and South Africa, dubbed the BRICS, are attending its 15th Economic Summit in Johannesburg, South Africa. Plans to expand the bloc and challenge the developed world's dominance, in particular the US dollar, by adopting a broad economic policy that seeks to move away from the US dollar-based trade within the bloc, is likely to top the agenda. BRICS countries account for more than 40% of the world's population and about 26% of the global economy. China, seeking to expand its geopolitical influence amid its ongoing rivalry with the US, has said it welcomes more like-minded partners to join the BRICS family at an early date. Russia also supports expansion, while Brazil has resisted, fearing it could undermine the group's stature. India has adopted a neutral stance. China has also been at the forefront of de-dollarization or attempts to shift away from the US dollar and use either an alternative currency or a new one to help ward off Washington's alleged currency weaponization. Graham, you covered this story for CTMfile, so if I may go with you first. From a Western financial system and or a corporate treasury perspective, what do you think of the plan for a bigger BRICS and attempts at de-dollarization?
Interesting push that you mentioned. Geopolitical was originally set up as a geo-economic platform. I don't think all the five members today really want the same things. China and Russia obviously are pushing for a geopolitical change. India, which I think is becoming more of an influential partner, as you say, wants more of a neutral stance. Quite interesting, actually, the symbolism. They're meeting in a week where both Russia and India have launched moon landings, and India has been successful, and Russia's crash landed a couple of days ago. Some symbolism in that, I think. I think the other thing, depending on which source you read, there are as many as 40 potential candidates to join BRICS, and you wonder how many of those are serious contenders. And I think India certainly, is very keen that they're assessed by their economic strength, and there are concerns that Russia and China want to line up geopolitical allies.
Yeah, Graham, I think, when I read this article, there's a lot of talk out there, de-dollarization. I don't agree with that in terms of the dollar's going away. If you think the dollar's going away, it's not going away.
Absolutely. I was going to mention, actually, the Financial Times today has a headline that says BRICs, the mighty dollar is secure for now. And I think that says it all, really. I quite agree with that. I don't see it being replaced anytime soon. I think it'll be small incremental steps, perhaps, over the years. There's moves to do deals like buying oil. India's buying oil from the United Arab Emirates in rupees, for example. So we'll probably see more deals like that in the years ahead.
I think what we see, at least what I see in the near term, dollar's going to remain, most influential. Do I think that the BRICS have the opportunity to gain some ground in terms of their currencies becoming more accepted in a trade environment? I do believe that that can happen. Their economic strength will have to increase quite a bit. The U.S. still has a massive amount of economic pull. When you think about China and Russia, it is political. There's no doubt about it. India has to remain neutral. They're kind of stuck in the middle right now, although I see India as a trading partner or a partner writ large in Asia becoming a much stronger bond for the U.S. When I think about digital currencies and the move in Asia, the acceptance or the thought of, a central bank digital currency or digital coins, it's something that's they grab onto or accept more readily in Asia than they do here in the Western, either Europe or in the U.S. What I would say is I think over time that will change. What I think the digital currencies will have the opportunity to do is change the way trade actually functions. The way the system works today, the dollar is needed, or a currency. If it wasn't the dollar, it would have been something else that we would have gravitated to settle transactions because it makes it easier that way. Once you get to a point where you have digital currencies in play and it's a global thing and it's widely accepted and it functions and it works, and you don't have to worry about money laundering, terrorist groups, or other access of evils, for lack of a better term, misappropriating the use of those types of currencies. And I think from a trade standpoint, it changes things and it brings down the complication. If I'm a treasurer and I'm thinking about from a treasury standpoint, if I'm domestically based, this would have little to no impact. If I am trading or selling goods and services globally, then something like this could have an impact on the way I manage my currencies. So that would be something as a treasurer I would be contemplating or thinking about. But in terms of the business itself, I think the business will continue to go. How trade is settled would obviously potentially change.
And I think the strength of the US dollar, that's obviously having repercussions around the world at the moment. I think there's possibly some resentment where that's pushing up import prices.
Those are great points. From BRICS, let's shift the conversation to China. China's central bank, the People's Bank of China, cut its one-year loan prime rate earlier this week to ramp up efforts to stimulate credit demand, but surprised markets by keeping the five-year lending prime rate unchanged. The Chinese central bank trimmed the one-year lending prime rate, a benchmark for corporate loans, by 10 basis points from 3.55% to 3.45%, but held the five-year LPR, which serves as the mortgage reference rate, steady at 4.2%. Evergrande, China's heavily indebted property developer, filed for Chapter 15 bankruptcy protection in a U.S. court last week. And besides a crisis in the real estate sector, China is battling deflation, record youth unemployment, weak consumer spending, and falling exports, adding to the case for the People's Bank of China to take bolder measures to stimulate the economy by embracing much larger rate cuts required to revive credit demand. Paul, should corporate treasurers of multinational corporations with considerable exposure to China be concerned about its faltering economy, or do you think they see a silver lining in China's recent economic woes?
Well, hopefully corporate treasurers have been paying attention to their exposure to Chinese investments or exposure to their economy. and the yuan. When I think about what's going on in China, China is going through something they haven't had to experience in a significant amount of time. They've been on a growth trajectory that is extremely robust, and now we're seeing a contraction, deflation. We're starting to see that there are concerns about the infrastructure of their financial platform. Banks are stressed. Lots of talk about shadow banks. The real estate is obviously taking a big hit. Evergrande going down, that is certainly significant. When we think about the interest rate cut and the message that Xi Jinping is sending here, it's almost that he's willing to allow the economy to still feel the pain now, because I think he figures that, hey, if we don't take this now and we try pushing or kicking it off down the road, we could have something that's much worse. So, it was interesting when they went out and they said, well, we're going to chop the 1 year prime, but the 5 year we're going to hold steady. So I think from a corporate treasury standpoint, if you haven't already been paying attention to what's going on, you have to pay attention now. I think there's more pain ahead for the Chinese economy. I don't think we're done seeing some of these headlines. There'll be some more, there'll be other companies, there'll be other aspects of the economy that will make headline news, I believe.
I thoroughly agree with that, Paul. I think it's interesting. It's only 3 years ago, Xi made this pledge to double the size of the Chinese economy within 15 years, so by 2035. And I think that's not going to be attained now. Obviously, COVID blurred things a little bit, but the fact, that this big rebound was anticipated at the end of last year when all the restrictions were lifted, and it's just not happened. That does show how serious the situation is. You mentioned the record youth unemployment push. I think it's quite interesting that they've actually stopped publishing the figures for that, which is a mark of quite how bad it is.
Well, yeah, you talk about data points that get published, Graham. But we know that when China publishes data, it's most likely not what the real numbers are, because the government controls those figures. But the message is significant when they don't report at all. That tells you that something significant is happening, and they don't want anybody to know.
They don't want anybody to know, and I wish that changed. Moving forward to the third story that merits discussion, it is about the Eurozone. The 20 countries that use the euro currency and their 346 million people saw modest economic growth of 0.3% in the second quarter of 2023, but the outlook remains relatively weak. The estimate for the Eurozone economy came from a flash estimate by Eurostat, the statistical office of the European Union. Ireland's growth of 3.3% was the largest in the Eurozone, and by contrast, the Dutch economy has entered a recession as it shrank 0.3% on a quarterly basis in quarter two, a first estimate published by Statistics Netherlands. Netherlands, the Eurozone's fifth largest economy, contracted for the second consecutive quarter after a 0.4% fall in GDP over the first 3 months of 2023. Graham, Eurozone registered a 0.3% GDP growth. Is that a positive sign following 2 quarters of negative growth last winter? And does it raise hopes that Eurozone can avoid a recession?
Unfortunately, probably not, Push. And as you mentioned, Ireland recorded growth of 3.3%, and I think that skewed the figure quite significantly, made it look rather better than it would otherwise have been. Though I think France and Spain recorded more modest but relatively decent growth figures. But Germany, which was supposed to bounce back into growth in Q2 after 2 quarters of contraction, I think it was zero actually. It was stagnant. And just new data out today for August for both the Eurozone and the UK, I think shows sharper than expected downturns in both the manufacturing and the service sectors. So that's not a good sign. We could even have the return of another period of stagflation, where inflation is still relatively high, but growth is minimal It's a real dilemma for the European Central Bank, because I think they were keen to follow the Fed and push up rates at least a couple of times more, and they're presumably having to think twice about that now.
Yeah, I gotta believe European central banks gotta be definitely thinking about that, Graham. I don't see how they're not. You know, when you have Germany flat, you really need Germany leading Europe in terms of economic numbers, and we're not seeing that here. Ireland leading, that's not the norm. You wouldn't expect that, but it's not robust where it needs to be. So I think from a European standpoint, it's not the numbers you really wanted to see when you start peeling the onion back.
I do wonder if there's going to be another nasty shock in months ahead. Certainly, we've had freak weather conditions over here, and that's going to have an effect on food prices in the months ahead. So hopes that inflation is going to be tamed. I think that's going to be put back yet again.
Well, we didn't even talk about, the impact on the war in Ukraine. That still is not subsided, and Russia's definitely looked to constrain food sources. So I think, there's continued pain there. So if you got inclement weather that impacts your crops, then that just exacerbates the issue.
Plus the fact that Germany, the biggest economy, Germans are being very sensible. They're holding on to their money, not spending.
They usually are sensible. That's the way they tend to be.
Those are terrific. There's a terrific analysis right there, and given that the war in Ukraine and inflation, it certainly is casting a shadow on Eurozone and the Netherlands, as it makes it more expensive for households and businesses to borrow, invest, and spend. Moving on to our fourth story, which is about Citigroup issuing the third edition of its Securities Services Evolution White Paper series, which shows the securities ecosystem faces challenging times ahead. The white paper finds that accelerated settlement is the single largest area of focus across all financial market infrastructures and market participants globally, with 77% of respondents expecting a major impact on their business. Our research shows that the rapidly accelerating move to T+1 in major markets poses significant challenges to industry participants, leaving an urgent need to drive innovation, automation, and efficiencies in global operating models, said Okan Pekan, Global Head of Security Services at Citi. Paul, after you reviewed the survey, what are the key findings from the survey that stand out for you?
Well, when we're talking about securities that trade across an exchange moving to a T+1, more like an equity trading platform for bonds, to be able to settle that fast, that's definitely something for corporate treasurers to consider and think about when it comes to not only the investment side of things, but also, as the article points out, securities lending. There can be impacts that ripple through those various programs that you have in place with accelerated trade settlement. I'm actually surprised that from a standpoint of being more efficient with trading platforms and information, that we haven't seen a movement to T+1 settlement sooner. Now, obviously, there's certain asset classes that are never going to be at T+1. I'm talking about things that don't trade across an exchange, that are private transactions. Those things, you're never going to get to those kinds of trade settlement areas. It's just, those are privately negotiated. They don't go across an exchange. So that kind of information and data can be a moving target. You might think you're going to settle a transaction today, and the lawyer's getting an uproar, and the next thing you know, it's a week later. So those kinds of transactions will continue to act and function the way they do. The ability to get those into your systems, I think that will be interesting, tackling those next. So if we're moving transactions that have gone through exchanges and traded T+3, or in some cases maybe as much as T+5, getting them down to T+1, I don't really think that's a bad thing. I just think corporate treasurers got to understand what that means for the programs that they currently have in place. And certainly from securities lending standpoint, that will change the way the programs function. So you just have to think about your ability to exchange securities or get securities back that you want to have for trade settlement. Getting securities back from a securities lending program can be extremely challenging sometimes. If it's a security that's in high demand, counterparties tend not to want to give up that security because they need it for collateral or something else. So you got to think about that from a trading standpoint, and how are you going to get that message across to counterparties that are currently holding a security you're trying to settle. So I think there's some challenges there.
Just a couple of things occurred to me reading it. Kudos to India again, because you mentioned Push, the transition from T+2 to T+1, and India went ahead with that last year and completed it earlier this year, so is ahead of North America in that respect. And also the use of distributed ledger technology. I heard about this for years as a concept, but it really seems to be widely adopted, or has been in the last couple of years.
Yes, DLT certainly is in the news. Finally, gentlemen, what is your choice for the biggest or the most important story of the past week, and why? Is it the BRICs expansion and de-dollarization story, China's slowing economy, Eurozone's modest economic growth, the Citi survey, or some other news item? Graham, can I ask you to go first, please?
Well, I'm going to cheat a bit, because I think long term, possibly the BRICS story, but I don't see any great dramatic transformations happening in the near term. It's going to be a longer term thing over the next few years. So in the near term, definitely China and the downturn there, because I think Paul is correct. There's going to be a lot more bad news coming down the line in the months ahead.
Yeah, I definitely think the China news, the stuff coming out of China is, going to continue to be the headline that I'm going to pay attention to and keep notice of. Here in the U.S., I can think about rising mortgage rates here in the U.S. have drove down home purchases to the lowest level since 1995. So we got our own pain that we're self-inflicting through rising rates, trying to slow our economy down. And China's got a complete opposite issue. They've got housing issues, but they have deflation and economic problems across the entire platform that I think is going to continue to be painful for them.
I'm reading some suggestions that the situation in China is increasingly resembling that of the US back in 2008.
They're in for a wallop then.
Well, thank you, Paul and Graham, for the valuable perspectives and informative analysis. That was a riveting conversation. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you and have a wonderful week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.